They're positioned really for the sorts of markets we saw in the first quarter of 2016, and by that I mean choppy, not necessarily moving in one direction, and a period where a variety of returns drivers are actually very beneficial in the portfolio. So we don't have too many eggs in any one basket. We have a diversified range of exposures to equity, both in terms of stock markets in certain regions, certain countries, but also within fixed income markets, income generating asset classes. We don't just have a particular niche, we have a wide range of different asset classes in the portfolio. So it's diversified, deliberately choosing assets that we think is going to deliver the right return with not too much risk over a full investment cycle. So the range provided returns of between low single digits to medium single digits over the quarter, and to give you some sort of context, the UK market was essentially flat over that period. So it's pleasing to see that the returns drivers and the diversification are in place even in an environment where you don't generate returns in the UK equity market. So what helped? Well, manager selection in the UK section, that's been an important area in terms of alpha or outperformance over not just a 3-month period, but actually the last 3 years. We felt that again and again in the portfolios. And then within the fixed income portion, we did poorly by being underweight governments. We compensated to an extent at least by being overweight various parts of the credit market. And then the final positive impact in terms of fund performance was being overweight gold mining shares. This is a niche little position for us. It's small at 2% because the amount of risk that comes with it. But that position went up over 50% in 3 months, and that benefited performance substantially. We still see good value in a number of the equity markets. The UK's okay. Europe and Japan are pretty cheap. As I mentioned already, the US looks a little bit expensive, but our opportunity set has shrunk slightly over the last couple of weeks, in fact, as the market rallied out of the February lows. So we took the opportunity to add to risk in January. We saw a lot of opportunities then, both in the equity market, but also in things like high yield and other parts of the credit market. And we've actually just started trimming that back again, taking profit there as the markets have run up. And we've already achieved or realised the sorts of gains we were expecting from those positions we added. Nevertheless, though, we're positive on the global economic outlook, and in that environment we think that equities or shares in companies will do well. We think government bonds won't do very well as inflation starts to reassert itself and yields normalise, which is bad for bond prices. And in that environment, we'd much rather be in places like high yield, where you still see good opportunity financially in terms of valuations, good opportunities in emerging market debt, convertible debt, and investment grade credit. Well, the key thing is we've got the flexibility in our philosophy that allows us to move quickly, to take advantage of opportunities as and when they're presented. And also the asset classes we buy and the managers we use, they're very liquid. We're able to move in and out in pretty short order, and that allows us to move capital to positions we see that are attractive and move them away from positions we think are unattractive very quickly indeed. The other thing we have is cash. We keep a reasonable amount of cash in the portfolios. We think of it as a store of dry powder. It's certainly not going to beat inflation anytime soon, but what it does do is it gives us an opportunity to put cash to work very quickly as and when we see opportunities present themselves in the market. Volatility often feels quite nasty. It's movements of prices, and often movements of prices correspond with movements down in markets. And as a result, people tend to view it quite negatively, understandably. What we try and do when we're faced with periods of volatility is reassess the opportunity set, and often it gives us cause to be modestly excited, because volatility equates to opportunities for long-term investors. So what we do when we see volatility, we bring out our proprietary valuation models, we reassess the markets in terms of their relative attractiveness, and we reposition the portfolios if necessary to take advantage of future conditions that this volatility today is providing for us. Even though it's uncomfortable, it is an opportunity for investors. Well, 2016 looks posed to provide us a number of challenges in the portfolios. We've got monetary policy decisions in Europe and Japan and the US, which had a bit of a stumble last year. We've got the presidential election coming up at the end of the year, and before all that, we've got the Brexit vote in the UK. So there's going to be lots of things going on this year. To that end, we build return-seeking positions in the portfolio, but also diversifying risk-reducing positions in the portfolio. And the key is getting the combination of those factors right. The reason being for that is because we're focused on the outcome and delivering the right returns for our clients, but we're conscious at the same time we've got to make the journey to the outcome as palatable as possible.